Waiting a couple of minutes for more participants to log on. It's about 7 minutes after 4, and we're going to try to keep this to about an hour or so. Everyone's time is pretty precious these days. So good afternoon and welcome to Connecticut CCIM's chapter's first webinar event. We're very excited to be here today. We'll be presenting the CARES Act and Beyond, presented by CohnReznick. I'd like to first start off by saying I hope everyone has been doing well during these trying times, and that it's the intention of the Connecticut chapter to host more of these types of events in the future. Before we begin, I'd like to thank our annual sponsors, BL Companies, Community Investment Corp., CohnReznick, Newtown Savings Bank, 10X, Dime Bank, JP McGuire, Chelsea Groton, Guilford Savings Bank, Ion Bank, Savings Bank of Danbury, and the town of Brantford. We appreciate your continued support. Thank you again. I'll now turn it over to Gus Ryer, who will introduce our presenter.
I was muted. Good afternoon, everybody. Thank you very much for coming today. I think we've got a great program coming up. And I would like to introduce Brian. With more than 35 years of professional experience, Brian Newman is a partner in CohnReznick's Hartford office and practice leader of the firm's federal tax services nationally. Brian concentrates on the formation, operation, and dissolution of partnerships, C corporations, S corporations, and limited liability companies. He also has extensive experience dealing with tax issues for family-owned and Fortune 500 businesses, serving clients across various industries, including real estate, manufacturing and distribution, technology, and construction. Brian is a frequent speaker and author on issues involving federal and state taxation and partnership taxation issues, and was appointed as an adjunct professor for the University of Hartford's Master of Science in Taxation program. As a past trustee of the Connecticut Society of Certified Public Accountants Educational Trust Fund, Brian is also actively involved in the greater Hartford community. Brian, welcome. Thank you so much for taking time out of your schedule to speak with us today. I'll be turning it over to you in just a moment. And if anybody has questions, please put them in the chat box. I will be monitoring it. And if anything comes up, Brian, I'll let you know and read them out for you.
Okay, great. Thanks, Gus, and I appreciate it. You know, CCIM is one of my favorite groups to present to. It's a group that's very interested in the real estate industry, obviously, and probably about 60 to 70% of my work is in real estate. So it's a nice fit. And over the last year or so, we have had complete changes with respect to tax laws and different things that affect the real estate industry. And so hopefully today we'll do an overview of those. I can get as detailed as you want, maybe at a later time if you see something that really piques your interest and you know, we need to get into it. But like I was telling people, literally on every single day, we are getting guidance coming out of either Treasury or the IRS, or even maybe an executive order or two on tax law changes that we turn around literally overnight to our clients, making sure that they understand the laws and making sure that in their businesses, they're completely up to date. So today what I wanted to talk about was the CARES Act. Even though this was an act that was passed a few months ago, there's still ramifications to it. We're still getting guidance on how to implement it. And also talk a little bit about the PPP loans, which is something that for a period of time literally took, you know, a whole group of us nonstop consulting with our clients during the application process, and now the process of the calculations of the forgiveness that we're talking about. So with that, I'll get started. Unfortunately, we're not in person, which I prefer, but certainly if you have any questions, just let me know, and glad that everyone logged in to go through this. So with that, I'm going to share my screen. And
Brian, while you're doing that, Carl Russell wants to know if you are the same fellow that ran the triathlon years ago, because he also participated in many of them.
yes, I am. Actually, that's one of the things that happened in my past life, and actually a goal of mine is in 2021 to possibly start competing again. So we'll see.
Fantastic.
Okay.
That's something that's always been beyond my reach.
Well, it's nice because there's all different distances, and so you can train for sprints or Olympic distance or, half or full triathlon. So something for everyone, and it's a great sport, and it's certainly changed over the years. So, and we could do a whole hour on that, I think, or more. So just, you can see my screen now, the presentation. Okay. All right, so this is just a disclaimer, making sure everyone knows that even though what you're going to hear today, I think is completely accurate, that you can't rely on it. And, our legal people always want to make sure we have the right disclaimer. So disclaimer there. And so let's get into it. The CARES Act. Everyone knows this was highly touted in the media that you had many taxpayers getting $1,200, $2,400 for married filing joint individuals, and $500 per qualifying family. Those checks have gone out. There's been a little bit of back and forth with the service on either checks that went to people that it shouldn't have or people who didn't get their checks, but that's being all worked out. And the other thing right now that we're seeing in the debate in Washington is whether we're going to see another round of that. And I think we will, probably under the same parameters, but right now there's kind of a logjam, and hopefully that will get resolved shortly. So if you got the recovery rebates, you know that you were within the income thresholds. And if you were over the income thresholds, then there was nothing to receive. Charitable contributions. This was something that was eased up. The limitation before the change, and this was a change in the CARES Act, was that for taxpayers that itemize, you could deduct charitable contributions as long as they didn't exceed 60% of your adjusted gross income. For cash contributions, that was suspended in 2020. So because the expectation was that people's income would be down, and people may have already made charitable contributions, so they wanted to make sure people got the benefit of any charitable contributions that were made. Also, taxpayers that don't itemize, there's going to be a space above the line in 2020 where you could deduct up to $300 of cash contributions and not itemize. One of the things that happened, and I'll use some acronyms, TCJA is the Tax Cuts and Jobs Act, and that was the act that we received in 2017 that was passed and signed by President Trump in September of 2017. So TCJA made a lot of changes, and then the CARES Act reversed those changes, a lot of the changes, to make sure that the ultimate goal of the CARES Act was to try to get cash into people's pockets, and especially on the business side, in order for the businesses to be able to continue to operate and their cash flow enhanced by changes in the tax law.
Brian, I don't mean to interrupt, but could you take your presentation out of presenter mode and just the regular old slideshow?
Okay.
Maybe make it a little larger for folks to see.
Okay.
And don't ask me how to do it. I'm not
Okay,
sure.
I was gonna ask you how to do that. Let's see if this works. Is that better? It seems,
No, it's still in presenter mode.
okay, so let me try something. Let me try something else.
Try, if you right click on it, you can say hide presenter view.
Okay. Okay. Yeah, I see
Yeah,
that.
so if you give your title slide a right click.
Yeah. Did that do it?
Not that I've seen. Oh,
Yeah.
no, that was the desktop.
Let's see. Is it, because now it says show presenter view.
Interesting. Well, you know, if it's not working, we can just we can keep going.
Do you want to try to share the screen and I could just say to advance the slide?
Bernadette, if you're able to do that on the fly and change it, is that something we can do?
Yeah, let me hop on.
Perfect, thanks. Sorry, folks, technical difficulties. Look at that, perfect.
Yeah, okay, great. Okay, so yeah, the next slide. Another change that was made in the CARES Act was that employers could make payments on behalf of people who have student loans, and the amount of the payment can be up to $5,250. And the employer can take a deduction for that. And the nice thing is that it's not taxable to the employee. And that's the same dollar amount that employers could fund educational assistance for their employees per year. So this was a nice added benefit for anyone who does have student loans, and an employer is looking to provide additional benefits. Again, deductible by the employer, not includable in the employee's W-2, which is nice. Next slide. So unemployment assistance, if you're following the news, unemployment assistance that was passed here in the CARES Act of the additional $600 per week ended July 31st. The executive order that was signed over the weekend by President Trump extended the benefits, but I believe it was an additional $400 a week, with a portion of that being funded by the states. And so we'll wait to see what happens there. Again, we actually have one of our partners who is on Capitol Hill, who follows the legislation, and we get overnight reports on exactly what's happening, but there's a stalemate right now. And so as soon as something comes up, you could check our websites, because we'll put something out as things are happening. With this was old news, this is at this point old news now. It was up to 39 weeks, ended July 31st, and there was no waiting period, and the additional $600 per week. So next slide. I just wanted to give people kind of a view of what happened here with state filing requirements and federal filing requirements. Now, when this, if you think back to March, the March timeframe, for the past year and a half or so, I was spending 2 to 3 days a week in our New York office and 2 to 3 days a week back in our Hartford office. And in March, early March, I was down in New York, and actually my daughter, who works for Google, for the previous month had been telling me, please don't go to New York. Everything that we're seeing here is that it's a real problem, especially in New York. And so she actually texted me the Monday was, I think, March 10th, 9th or 10th. And she says, Google has decided that we're working from home for an indefinite amount of time. And so that's kind of when everything started to happen, where, you know, companies started to shut down operations, move people to a work from home status. CohnReznick actually, over that week, we moved 2,500 people from our 26 offices to working from home and testing our infrastructure and making sure that it could work properly. Now, what ultimately happened was a lot of tax returns, flow-through tax returns, LLCs and partnerships that are calendar year ends are due March 15th. And so we were obviously working towards that deadline, and some thought that we might even get a reprieve at March 15th, but that didn't happen. And then shortly after the March 15th deadline, we got the notice that says we're moving April 15th to July 15th. Now, to a lot of lay people, that may seem like, okay, no big deal. We're just moving from April 15th to July 15th. But then as you start to read the notices as a tax professional, you start to see that the notice didn't encompass certain things, like if you had to have foreign filing documents in your tax returns, it was thought originally that those would not get extended until July 15th. We also started talking about states, and, you know, states don't automatically conform to the federal. And so we quickly put together this map of, you know, which states conformed to the July 15th, which states moved to a different date. And this was the only filing requirements. Don't forget that federal government said, not only do you not have to file until July 15th, but you also don't have to make either balance due payments or estimated tax payments by July 15th. But some states didn't move their payment dates. And so, you know, we have 1,000 tax professionals dealing with our clients and saying, okay, you don't have any federal taxes due on April 15th, but you may have state taxes due, and you may have extensions due at that time. So it was really, really a mess for us with the movement of this date. But we got through it. July 15th seemed to be a little bit tougher than April 15th would have been, but again, got through it. So this map shows which states moved the deadlines to July 15th, which states moved to deadlines other than July 15th. And it also shows in the orange places that you want to retire, places that have no personal income tax. And so you keep that in mind as you get closer to your retirement dates. Next slide, please. So let's talk more about some more changes under the CARES Act. TCJA changed the law on net operating losses for both individuals and for corporate entities. Before TCJA, you could, if you had a net operating loss, either an individual or a corporation, the individual or the corporation could either carry back the loss 2 years or forward 20. That was the law. TCJA said no more carryback. So if you have a loss, and say in 2020, under TCJA, you couldn't carry it back to either 18 or 19. You had to only carry it forward indefinitely. And there was a limitation on how much of that loss you could use. And we never had a limitation like that before. And the limitation was that only the net operating loss could only be used to the extent of 80% of your taxable income. And so what that did was it slowed down the benefit of having that loss in the current year, because you couldn't carry back to get at taxes that were previously paid, and you had to wait until subsequent years when you actually had income to offset. And if you had income to offset, you could only offset 80% of the taxable income, which would mean that you'd still have some kind of tax to pay. So all those changes under TCJA were impacted with the CARES Act. And what the CARES Act did was it said for net operating losses, you could carry back 5 years now, and there's no limitation on the 80% limitation was removed, so you didn't have that limitation. And we'll talk more about this in future slides. Also, with IRA distributions, CARES Act provides 2020 that you do not have to take a required minimum distribution. The thought there was that at the, early on, retirement accounts were significantly depressed because of the market, and to require people to take money out was, an added detriment. So they decided that if you didn't need the money, you didn't want to take the minimum required distribution, you could leave it in. Okay, next slide. So estate planning, one of the things that, quickly came to mind as all this started to happen in March and April is that you were seeing assets, next slide. You were seeing assets that may be significantly depressed in the marketplace. And when that happens, that's a good time to think about estate planning and transferring assets to the next generation, because a gift is based on the value at the time of the gift. And so if the value of, say, a piece of property was significantly less than it was before, now would be a good time to consider it in your estate planning and meeting and having the value transferred out of your estate at a lower rate, a lower amount versus when the value was higher. And so our estate planning people were meeting with clients, and clients were considering whether if they didn't have the amount of about $11 million already transferred to other family members, it was something that they were considering. One thing to keep in mind, Connecticut is one of the only states that does have a gift tax, and the exemptions are much lower than the federal exemptions. So if you are making gifts and you're over certain dollar amounts, there may be a state gift tax to pay. So something to keep in mind. Next slide. So on the business side of things with the CARES Act, next slide. We talked about the NOLs and the 80%, and under TCJA you couldn't carry it back. This is something that you really need to talk to your tax advisor about, because if in fact you did have NOLs, net operating losses, in 18, 19, or 20, there's things you could do now to generate cash and get cash back from the government. Also, if you have a corporation and the corporation had a fiscal year end and you had an NOL in 2017 fiscal year, that's another thing to talk to your tax advisor about, because there's special rules for that because of what happened with a fiscal year corporation in 2017 under TCJA. So if I'm ringing any bells with you on these things, please talk to your tax advisor and don't miss the opportunity to be able to carry things back. Another area that really hit some real estate professionals was something called the excess business loss limitation. And again, that was a TCJA law change where pre-TCJA, if you had losses coming through from your business, you were able to offset any other type of income that you had, whether it be investment income or wages or anything else. As long as you got over 3 hurdles, and we call them the 3 hurdles, and the loss ended up on your tax return, you could offset it against any other type of income that you had. And those 3 hurdles were basis. You have to have basis in order to deduct a loss. You have to be what's called at risk, which means that you either have to have capital in the deal, or you have to have recourse debt, or there's a special rule for real estate where qualified non-recourse financing provides you at risk. And also you have to be active versus passive in the business. So as long as you get over those 3 hurdles and there's a loss, then that loss could have been deducted against any other type of income you have. With TCJA said, we have a new rule that says if you have what's called an excess business loss, which means that the losses coming through from your business could only now offset $500,000 of other types of income that you have if you're married filing joint, or $250,000 of income if you are single, or if you're married filing separately. This was a huge hit for a lot of people where they weren't able to deduct currently all their losses. TCJA postponed the enactment of the excess business loss rule until after December 31st, 2020. Now, what that means is, again, if you were subject to this rule in 2018, then you need to go back and you need to amend your return, because you could actually offset more losses and reduce the amount of taxes that you paid in 2018. So that's another item to really talk to your tax advisor about and say, you know, was I subject to 461 or the excess business loss limitation? If you were, file the amended return and get the money back. It's something that has been very beneficial for a lot of our clients and has freed up taxes that were previously paid, and again, helping to fund business operations. Next slide. Okay, this slide is on the special rule for the fiscal year returns that I was talking about in 2017. Limited applicability. Again, if you do have a C corporation that had an NOL in 2017, and that C corporation is a fiscal year, and you had a loss, something to go back on and take a look. Now, one of the things that we always think about when we get new tax law, if you can see the procedural relief down below, it's nice that these rules get passed, but then the implementation of these rules is something that we sit there and say, okay, how do we think the service, the IRS, is going to implement these rules? And they actually provided, in this go around, they actually provided simplification in order for taxpayers to actually file their claims, their carryback claims, so that they could speed up the process of actually getting the cash back. And the process was that you could file by July 31st, Form 1139, and you could actually fax it to them. There was a special fax number that you could fax the form to them on a carryback claim, which would generate the refund, and they would send you out to cash a lot quicker. So again, you know, kudos to people who are thinking about this from the IRS's side and making it so that the taxpayer could quickly get the relief that they were looking for. Next slide. Okay. I'm going to just briefly say that there was anytime you get new tax law, and it's, I'm not going to say that it's not well thought out, but you can't think of everything. You know, the writers usually don't think of everything. There was an interaction of pre-TCJA NOLs and TCJA NOLs, and that got clarified in the CARES Act, and it got clarified to the detriment of the taxpayer. And so if you want to go back and take a look or talk to me later on that, we could walk through the example. So next slide. Okay, corporate AMT. If you do have a corporation and you were an AMT for previous years, TCJA repealed the corporate AMT, but also if you had an AMT credit, which is you paid AMT tax that was ultimately credible for future years, you were going to receive that credit over a 4-year period. The CARES Act said we're going to eliminate that 4-year period, and we're going to get you that credit back now, that refund now. And again, a focus on getting people cash in order to operate their businesses. Okay, next slide. Okay, so this, 163J, or the business interest limitation, this was something under TCJA, I have to say, is probably the worst piece of legislation I've seen in my 35 years of being a practitioner. And basically what this says is that if you have interest expense, business interest expense, TCJA limited that business interest expense to 30% of your adjusted taxable income. And so if you had high interest, you were limited on the deductibility of the interest expense. You didn't lose it, but it got carried forward. And you would think that, okay, so you get limited in 1 year and it gets carried forward, and then we could figure out how to use it. We got well over 600 pages of regulations on how to implement 163J. And so this has really been kind of a thorn in the side of a lot of practitioners. I could tell you that I've been on calls with other firms, and this is no dig on anyone, where we were just arguing over what the right answer was. And the reason why, the reason why there were so many different opinions is because the guidance was not clear. The IRS sometimes would put out things that they put out, sometimes they'll put out something in a revenue ruling or a revenue procedure or a notice, an IRS notice, but they also have something they put out called frequently asked questions, which in the hierarchy of what we look at as practitioners, the hierarchy of what is acceptable to us to rely on, the frequently asked questions, you could see where the IRS is thinking, but it's not something that is authoritative really in any way. And so what the IRS did was they put out a frequently asked questions in the 163J area, and one or two of the answers to these questions we didn't necessarily agree with. We looked at it very, very closely, and from a technical standpoint and the way the law was written, and said, do these frequently asked questions relate to how the law was written? And they didn't. And so we were advising our clients on things that they would have to take positions on, or that they would have to say, what, I see what the frequently asked questions say, or I see what our proposed regulations say, but we also see what the law says. And ultimately, if we think we had a better answer and we were going to take a position, and maybe sometimes we had to disclose, sometimes we didn't, ultimately it was like kind of driving in the dark without headlights. Because a lot of the guidance was not out yet. So what happened was we got TCJA, we got the 163J, we implemented that over the 2018 tax filing year. So you're on the 2018 tax return. And then of course we get the CARES Act, which says, hold on a minute. What we're going to do is we're going to lighten up on the limitation. And instead of it being 30%, we're going to make it 50%. And so when you start to read that, you say, oh, okay, good. That's going to help some taxpayers. But then in someone's infinite wisdom, the 50% is for corporate entities and not flow-through entities. And what they said was on the flow-through side was that in 2019, you're still limited based on 30%, but in 2020, you're going to be able to get a benefit based on the differential that you didn't get between the 30% and the 50%. So again, we have to make our lives difficult, and we have to make it so that, taxpayers are kind of pulling their hair out of their head and saying, gee, how come I couldn't get that benefit in 2019 like everyone else did? But ultimately, that was the law. It's being implemented now. Like I said, we did get final regulations in the area, and we did get some guidance and some clarity on certain things that I want to talk about because it relates specifically to real estate. One of the items is on triple net lease properties. Based on the proposed regulations that we got, triple net lease properties, we believed if it didn't rise to the level of a trade or business, and this is always an issue in the real estate world as to whether the ownership and operation and leasing of real estate rises to the level of a trade or business in the eyes of the IRS. And the IRS has taken the position that triple net leases most likely do not rise to the level of a trade or business for purposes of, everyone probably heard about the 199A deduction, which is the qualified business income deduction. IRS says, no, doesn't rise to the level of a trade or business there. And so when you read the 163J regulations, you say, okay, over at 199A, they say it doesn't rise to the level of trade or business. There was nothing in 163J that would lead you to believe that a triple net lease would rise to the level of trade or business. Unfortunately, in the final regulations say that triple net leases for 163J purposes do rise to the level of trade or business. So you would have interest limitations with triple net leases. And so that's something, if you do have triple net leases, please talk to your tax advisor, because that was just a change that was released within the last week or so. That's one thing. Another thing that is beneficial is that they limited the scope of what the IRS considered interest for purposes of this limitation. In the original proposed legislation, the IRS literally threw everything into this bucket and called it interest. Like, for instance, amortization of loan origination fees. They said that was interest expense. And so they lightened up on that in the final regulations, and that was taxpayer friendly. So the nice thing in the real estate world is that if you are subject to these limitations, you can make an election called a real property trade or business election and elect out of 163J, which means that you could deduct all your interest. The detriment is that you have to depreciate your property, both if the real property and qualified improvement property, under longer depreciation lives. So that's the give up for getting the benefit of being able to deduct all your interest expense. And we'll talk about qualified improvement property later, but so if you do elect out of 163J and are able to deduct all your interest because of the election out, that means you can't take bonus depreciation on your qualified improvement property, which we'll talk about later. Again, if you elected out of 163J in 2018 or 19, this is another thing in my 35 years, I have never seen the IRS allowed you to go back and revoke an election that you made. So that's something you could still do. You should think about it and think about how it affects you in conjunction with the fact that they made a change to the qualified improvement property, which we'll talk about. So next slide. We talked about the partnership rules. 2019 remains at 30% of ATI, which is adjusted taxable income, but for next year, you're going to get the benefit of the difference between the 30% and the 50%, plus you'll get the 50% limitation in 2020. So 2020 is the year that there's a big benefit if you didn't elect out for partnerships. Next slide. Okay, so if you're in the real estate world and you're in commercial real estate, you know, because you've been living this nightmare for since 2017, that there was a drafting error in TCJA, that qualified improvement property was supposed to have a 15-year life under the bill, and it was supposed to be eligible for bonus, but because of a drafting error, the bill came out and was finalized, and qualified improvement property had a 39-year depreciable life, and you were not able to take bonus depreciation on it. And we had a lot of clients who were, you know, obviously trying to lobby to get this changed, because everyone who, you know, everyone you talk to, if you talk to a senator, you talk to a representative, everyone agreed, and the IRS agreed that it was a drafting error and it should be something that gets 15-year amortization and bonus eligible. But because the bill was finalized the way it was, the IRS didn't have the authority to make any changes, and it needed a legislative change. For the past 2 years, we've been trying to get that legislative change, and every time it was brought up, it was attached to other things that didn't pass. Luckily, it got into TCJA, and so now you do have qualified improvement property that has 15-year life. So what does that mean? You know, if you think about the 2017, 18, and possibly 2019 tax returns that were filed before the CARES Act, and you took 39-year depreciation on it, you could go back and you could amend those returns and take the entire amount of the qualified improvement property, 100% deduction in the year that it was placed in service. That's one way to handle this. And this was another thing that we were talking about implementation. How does this get implemented when they made the tax law change? There's another way that you could handle this. Instead of going back and amending the returns, you could actually file what's called a Form 3115, which is a change in accounting method. And so let's say you put property in service in 2018 that is qualified improvement property. You started to amortize it over 39 years because that was the law. The law changes in 2020. You're getting ready to file your 2019 return. You can actually take the benefit, the 100% bonus, if you file this form in your 2019 return, instead of having to go back and amend your 2018 return, which is a nice option. Obviously, it's another area where you have to see where you're going to get a better benefit and see what the issues may be. And again, if you elect it out of 163J, so you're deducting all your interest expense, you're not allowed to take bonus on this. But it's not 39-year property anymore, it's 15-year property, so you still get a benefit for the tax law change. Next slide. Corporate contributions. If you have a corporation, the Act increased the limitation from 10% to 25%, which is nice. And then there's a temporary exception for excise tax on alcohol used to produce hand sanitizer, which was also another nice thing. Next slide. For anyone who is looking at opportunity zone investment, there were some changes due to COVID-19 when the president declared presidential disaster area for the entire U.S. There is a code section that says that you could postpone things going forward, and so what happened was there were 3 different changes for ozone. So if you're going to make an opportunity zone investment, the investor has to make an investment into a qualified opportunity fund within 180 days of certain time periods. And so if your 180-day period fell on or after April 1st, then the 180-day period is extended to the end of this year, which is nice, and it gives people time to make that investment. So that was a nice change relating to qualified opportunity zone investment. Next slide.
Sorry, Brian, not to interrupt, but
Yeah.
to go back to the depreciation change,
Yeah.
we have a question from the audience asking if that's for users, investors, or both.
Both, as long as it qualifies as qualified improvement property. Okay, and so it has to be property that's made to the interior of commercial property. It's not anything relating to multifamily or residential property, but it has to be interior, the walls, any kind of leasehold improvements that you're making to the interior of the building. Also, it can't be things like, facades or anything like that. It has to be interior. Okay.
Thank you.
Okay. And again, if you're in the ozone world, there's a investment standard that 90% of your investment has to be in a qualified opportunity zone business property, and there's calculations that have to take place in the first 6-month period and at the end of the taxable year. And for anything beginning after April 1st, 2020 and ending December 31st, 2020, you're not going to have to meet the 90% investment standard. You're going to you're going to be deemed to meet the reasonable cause exception from the penalty. So that's another nice thing, another benefit, or something that was relaxed due to COVID-19. Next slide. Also, with investment in qualified opportunity zone businesses and business property, you have 30 months in order to do what's called substantial improvement, and that 30 months is on hold, and you have, I believe, 2 years now beyond the 30 months in order to get a 24-month period has been extended. So again, where people thought that you needed to meet all these tight deadlines for opportunity zone property and opportunity zone investment, and kind of the world came to a halt with respect to construction and with respect to investments and raising funds. All these items were extended so that there wouldn't be penalties, or that ultimately your deal wouldn't blow up. Next slide. Okay, so employer considerations. The first act that we got was the Families First Coronavirus Response Act, and this had to do with a lot of changes or a lot of benefits that were helping employees that were either home because of COVID, either they had COVID, they were caring for someone with COVID, they were home because their kids were home from school. And so these were all law changes that that came under the Families First Coronavirus Act. And we did a lot of consulting with our clients, because one of the biggest issues was, it said fewer than 500 employees. And it was like, okay, so who has 500 employees and who doesn't? Do you count entities that are related? Don't you count entities that are related? And there was, again, no clear guidance, but we got through all that. And in the interest of time, I want to kind of skip over the FFCR slides, and anyone who wants to, call me up or come back to them, we could certainly talk about them, because they're mostly related to employee benefits. The one thing I did want to mention is that there's the ability to defer your payroll taxes for up to 2 years, and also if you had a substantial decline in your business and your business operations, and you continued to pay your employees for a period of time, there was something called the employer retention credit, which you can get, and that's something to take a look at. And if you do qualify, it's a nice credit to get. So next slide. We talked about that. Deferral, talked about that. Next slide. Another CARES Act benefit is that if you're under age 59 and a half and you were affected by COVID, you could withdraw up to $100,000 from your IRA without incurring the 10% excise tax. You still have to pay the tax, but you weren't subject to the penalties. Next slide. Let's go on from here. Wanted to talk a little bit about state and local. Next slide. You know, I live in the federal tax world. My colleague on the state tax side, the person who is head of the state and local tax group, he probably has it a little more difficult because he's trying to deal with 50 states. You know, did they extend deadlines? Didn't they extend deadlines? What's happening with trust fund taxes? Because if you don't know, you know, trust fund taxes are things like sales taxes and payroll taxes, and there's a responsible person. And so they could effectively pierce the corporate veil and come after the person who's responsible in order to pay those taxes. So he's dealing with that, you know, who has to make the deposits, who does not. We had clients who came to us and said, you know, I literally can't make these deposits. What do I do? And so he was very busy in that area. But so those were kind of the things to watch. And then if you do get penalties from states, it's always worth trying to get those penalties abated if you do have reasonable cause. Next slide. Okay. So, of course, everyone working from home, you start to have state tax issues. And you might have read about some of this where, so for instance, in our New York office, we have people who commute in from Connecticut. We have people who commute in from New Jersey. Some people might live in the city. And all of a sudden you're working from home and you're not working in New York anymore. And so the first question is, you know, from an employee is, well, if I'm not working in New York and I'm working from Connecticut, how come I'm still getting taxed as, you know, earning my wages in New York? And of course, New York, you know, there was no surprise. New York said, we believe you're still working in New York. You're just working from home. And so we're going to collect the tax. So, you know, these are the types of things. We had people who, you know, picked up and went to Florida or other places and are working there. And they said, hold on a minute. I'm working from Florida where there's no income tax. How come I'm getting taxed in New York? So I actually had a staff who called me from LA and said, my apartment lease is up at the end of the month. I'm moving to Hawaii for the next 6 months. I'm going to work from there. I'll work LA hours, and because it doesn't really matter where I am anymore right now. So I might as well be in a place where, you know, I want to see and experience. And so, you know, we got a lot of people who are doing that. A lot of our younger staff who are more mobile, or they went to their parents' houses and stuff like that. So, you know, you have to make sure as a business that you're adhering to the state tax laws and making sure that, you know, you're withholding in the proper states and everything, because there are penalties. So those are some of the key issues on the state tax side. Why don't we fast forward in the interest of time? It's 5 o'clock and we didn't even. Let's talk a little bit about the payroll protection loans. And high level, I think people know that you know, you're able to get up to $10 million, 2.5 times your trailing 12 months of payroll, up to $10 million. And if you spent it on the right things, which was 60% wages, up to at least 60% wages, and the rest on utilities and other things, that the loan became forgivable once you went through a process of getting the forgiveness. Now, of course, the first thing that, you know, people started to ask is, there's a general rule that says cancellation of indebtedness is income to the person who received the cancellation. In the tax law that in the CARES Act, where you know, we got the payroll protection, or actually it was in the Families First, where we got the payroll protection plan program. They said right in that law change that the income, that if you got forgiveness on the debt, it would not be taxable income. So the next question is, okay, I paid a bunch of expenses like I paid payroll, I paid my rent and everything, do I still get to deduct those expenses if the loan gets forgiven and it's not taxable to me? Because that effectively would be a double dip. You would get a deduction for the expenses that you did pay, but you wouldn't have to show the amount that came in as income. And so the IRS came out with what I thought was, you know, the exact right analysis, and said, to the extent that anything is forgiven, you know, the loan is forgiven, that you would not get a tax deduction for the expenses that you paid. It's literally within hours of that notice coming out, Congress said that was not the intention. The intention was that you would get a deduction for the expenses paid, even if the loan was forgiven. And so we're expecting that they'll make that law change with the next round of coronavirus relief. So that's number one. So we're waiting for that change. The other thing is that another thing we've been dealing with our clients on the PPP loans and the forgiveness is the timing of the forgiveness. The forgiveness has to be done through the SBA. And so, and there's a process where you have to fill out the paperwork, you have to submit it to the bank, and the bank has to then submit it to the SBA. And you could have a issue where it spans tax years. So, you know, at the end of 2020, if your loan has not been forgiven, you can deduct expenses because you have a loan and it hasn't been forgiven yet. And then the question is, okay, when it does get forgiven, maybe in the subsequent year in 2021, what does that mean? Does it mean that you have to recapture those expenses that you deducted? And under current law, I think that's the right answer. But we're waiting for additional guidance on that. And the SBA puts out, you know, additional guidance all the time. So we have a team actually of people who have been following the SBA guidance on a daily basis and sends it around. Next slide. You can see what the standard terms have been. You know, it's a 1% interest rate. It's a standard promissory note, no collateral, no personal guarantees, and it's either a 2-year loan or a 5-year loan if it's not forgiven. Next slide. And again, allowable uses: payroll, you could pay bonus, vacation, sick pay, health insurance, retirement benefits. You could pay rent, real and personal property rents, heat, light, gas, transportation. Internet's a question, and then secured debt interest. Expenses, the expenses have to be paid, the accrued and paid.
So Brian, one of the things that may be of interest to some folks on the call is we're in large part independent contractors, and we get paid on commission. So would, let's say that you got a PPP loan and you just took that whole thing as a lump sum, like a commission, would that all count as payroll?
Well, if you got the PPP loan, it was based on your earnings from the prior year, you know, the rolling 12-month period. And so it would depend on, you know, as effectively what you pay yourself, and, you know, it's up to the $100,000 per person. So it should count. And, you know, of course, paying your other expenses like your utilities and everything else. So there's, you know, you should be able to get the forgiveness as well. Okay.
Thank you.
Okay. Next slide. And then one of the big things we've been doing now with our clients is calculating the forgiveness. That's another big thing. You know, we've actually been working with some banks because the banks are understaffed on, you know, the calculations and making sure that they have signed off to the calculations before they go over to the SBA. So again, if you need help, you know, talk to your tax advisor, talk to us. But the goal here obviously is to maximize the amount that's forgiven. Next slide. And, you know, a lot of people were concerned early on because there were, you know, you'd see things in the media all the time about, you know, if you were taking these loans and you weren't in, you know, and they thought you weren't entitled to them, they actually said that there were criminal penalties associated with it. And, you know, and we were, you know, I have a, you know, a real life scenario was I have a client who has a bunch of restaurants and they're mostly takeout, and he was doing well, and he wasn't really affected by anything because of the takeout nature of his business. But his suppliers kept telling him that they were going to reduce the amount of his supply on his you know, raw food products by over 50% because the supply chain was going to dry up. And so the question is, he says, okay, right now I'm not affected, but I think I'm going to be affected. And what happens if ultimately I'm not affected? I take this loan, and then a year later someone comes in and reviews this and says, well, gee, you know, they have the benefit of hindsight and saying you were never affected by it, and it becomes a criminal issue. And, you know, so it put taxpayers in a lot of in a hard spot in many situations about whether to take the PPP loans or not, because you know, while taxpayers thought they were entitled to them and everything, they were very concerned about criminal penalties associated with it. So that was another area where, you know, we were asking people to seek their, you know, talk to their attorneys and walk through it with them before they take the loans. The other day, SBA started accepting applications for forgiveness, so we are hoping that that process goes smoothly. Next slide. There is another program, Main Street Lending, which if you were too big for the PPP loans, there was the ability to get a Main Street Lending loan. These loans are not forgivable, but they are low interest rate loans, and you know, you would be able to at least help to fund your operations. So that was an alternative for some of our clients. Okay, next slide. And then the rest of the slides are kind of, you know, what we put together internally in our firm, because it was something that you know, early on in March, April, May, accountants were working around the clock to help their clients get through, you know, these times that were, you know, unprecedented. They really were. And so, you know, we put together a whole team of individuals to work on this and to make sure we had all areas covered for all industries. You know, one of the industries that we serve, that we have a very high profile in, is the hospitality industry, both in restaurants and hotels and everything. And those industries, as you know, got decimated. And so there was a lot of effort there. The real estate industry, you know, a lot of people were very concerned. You know, they're still concerned about, especially as the unemployment is either being reduced or drying up, as to whether, you know, people will be paying their rents in multifamily. There's concern about businesses' ability to continue to pay rents and everything. So we made sure that we had our industries covered, and we were talking to our clients about it. Next slide. And if you want to go to our website, there's actually a resource center that you could go to, and you could look at federal taxes and restructuring and dispute resolutions and the SBA side of things. So it's all covered there. Okay. And questions?
Anybody out there have any questions? Give it a 30 seconds or so while you type it out. I've got some thanks for the presentation.
Yeah.
coming in.
Yeah, and I see that. And Frank, sorry I can't see you guys in person. I'm hopeful that we can all, get together at either breakfast or afternoon and actually do this in person again.
That would be great.
Yeah.
Well, Brian, it looks like you covered all the bases. So thank you so much. And we really appreciate you coming by. Erica, I'll pass it back to you.
Okay.
Okay.
Well, thank you, Brian, again. And everyone, thank you for logging on and joining our webinar. And like I mentioned, we will be having more of these in the near future. And just check our website and check your email.
Okay.
And have a good afternoon.
Thank you, everyone.
Thanks, everyone.
Okay, bye.
Bye.